Imagine a canary in a coal mine. These small, delicate birds were once a crucial part of mining operations. Miners would carry them in cages deep into the underground tunnels. The reason? Canaries are incredibly sensitive to toxic gases like carbon monoxide and methane, which are both colorless and odorless. These gases can be deadly, and without a way to detect them, miners were at constant risk. The canary, with its heightened sensitivity, acted as an early warning system. Miners used to take these birds underground because canaries are very sensitive to dangerous gases. The canary's role was simple, yet vital. As long as the bird kept singing, the miners knew the air was safe to breathe. But if the canary stopped singing, or worse, died, it was a clear signal that the air had become toxic. This gave the miners precious time to evacuate and save their lives. If the canary stopped singing, it was a warning sign for the miners. The silence of the canary was a stark and immediate alert. It meant that the miners had to act quickly to avoid the invisible danger that was now present in the air around them. This simple yet effective system saved countless lives over the years. It meant they needed to get out fast. The urgency of the situation could not be overstated. The miners would drop their tools and make a hasty retreat to the surface, knowing that every second counted. The canary's silence was a life-saving alarm that could not be ignored. In the financial world, US Treasury yields are like that canary. Just as the canary provided an early warning to miners, Treasury yields can signal the health of the economy. These yields are the return on investment for US government bonds, and they are closely watched by investors and economists alike. They can give us early warnings about the health of the economy. When Treasury yields are high, it generally indicates that investors are confident in the economy's growth prospects. Conversely, when these yields fall, it can be a sign that investors are becoming more cautious. They might be worried about potential economic downturns or other financial uncertainties. When these yields fall, it can be a sign that investors are worried. They're seeking safety. A drop in Treasury yields often means that investors are moving their money out of riskier assets like stocks and into safer ones like government bonds. This flight to safety can be driven by various factors, including geopolitical tensions, economic slowdowns, or even unexpected global events. Think of it like this. When you're worried about a storm, you might bring your patio furniture inside. You're protecting your belongings. Just as you take precautions to safeguard your home and possessions, investors take steps to protect their financial assets. They seek out investments that are less likely to lose value in turbulent times. Investors do the same thing. They constantly assess the economic landscape and make decisions based on their perceptions of risk and safety. When they sense trouble on the horizon, they adjust their portfolios to minimize potential losses. When they see trouble on the horizon, they move their money to safer investments. This behavior is a natural response to uncertainty. By reallocating their assets, investors aim to preserve their capital and avoid significant financial setbacks. US Treasuries are considered a very safe place to put your money. These government bonds are backed by the full faith and credit of the United States, making them one of the most secure investments available. In times of economic instability, the demand for Treasuries often increases, driving their yields down. So when Treasury yields fall, it's like the canary getting quieter. The falling yields serve as a signal that investors are becoming more risk-averse. They are prioritizing safety over higher returns, much like the miners who heeded the silent canary's warning. It's a sign that investors are getting nervous about the economy. Let's find out why. Understanding the reasons behind these movements can provide valuable insights into the broader economic picture. By paying attention to these signals, we can better navigate the complexities of the financial world and make more informed decisions. For 6 weeks straight, the financial markets have been sending out signals that are hard to ignore. US 10-year Treasury yields have been falling consistently, week after week. That's not something you see every day. In fact, it's quite unusual and has caught the attention of many experts. It's a pretty big deal. When yields drop like this, it often signals that investors are seeking safety. It tells us that investors are feeling uncertain about the future. They're worried about what might be coming next. Imagine you're planning a road trip. You wouldn't just hop in the car without checking the weather forecast, right? You'd want to know if you should pack an umbrella or snow chains. You'd want to be prepared for any situation. Investors are the same way. They want to know what's ahead for the economy before they make big decisions. They study economic indicators, market trends, and forecasts to make informed choices. When yields fall for 6 weeks in a row, it's like the economic forecast keeps getting worse. It's a sign that something might be wrong. Investors start to worry that the economy might be heading for trouble. They become more cautious and look for safer investments. Investors are starting to wonder if a storm is brewing. They see the falling yields as a warning sign, and they're taking shelter in the safest place they can find, US Treasuries. These government bonds are considered one of the safest investments. By moving their money into US Treasuries, investors are trying to protect themselves from potential economic downturns. They hope that by doing so, they can weather any financial storms that might come their way. The falling yields are a signal that can't be ignored. It's a sign that investors are bracing for uncertain times ahead. As we watch these trends, it's important to stay informed and understand what they might mean for the future. The financial world is always changing, and staying ahead of the curve is crucial for making smart investment decisions. So, keep an eye on those yields and stay prepared for whatever the market might bring. One reason investors are feeling uneasy is the recent economic data. It hasn't been very encouraging. Think of it like getting a bad report card. It's not the end of the world, but it's definitely not what you want to see. Recent reports on manufacturing and consumer spending have been weaker than expected. These reports are like taking the economy's temperature, and right now, it seems like the economy might be running a bit cold. This weak data is making investors nervous. They're starting to worry that the economy might be slowing down, and when the economy slows down, it can be bad news for businesses and investors alike. Remember when a gallon of gas cost an arm and a leg? That was inflation rearing its ugly head. And guess what? Investors are worried it might be coming back for a second helping. Recent surveys show that people are expecting prices to rise in the future. This is like seeing dark clouds gathering on the horizon. It doesn't mean a storm is definitely coming, but it's enough to make you grab an umbrella, just in case. When people expect prices to go up, they tend to spend more money now. This can actually make inflation worse, creating a vicious cycle. Investors are well aware of this danger, and it's making them jittery. Section 5. Stocks and oil slide. Seeking shelter in safe havens. The stock market can be a bit of a roller coaster, and lately it's been on a bit of a downward spiral. The same goes for oil prices. They've been slipping and sliding like a penguin on ice. When the stock market and oil prices fall, it's like someone just yelled "fire" in a crowded theater. Investors get spooked and start looking for the nearest exit. And where do they run? You guessed it. US Treasuries. Section 6, February 21st, a day of reckoning for Treasury yields. On February 21st, 2025, US 10-year Treasury yields fell to a 2-week low. This unexpected drop sent ripples through the financial markets, causing a wave of concern among investors and analysts alike. The 10-year Treasury yield is often seen as a barometer for the overall health of the economy, and such a significant decline can signal underlying issues that may not be immediately apparent. It was like all the worries and anxieties investors had been bottling up finally bubbled over. The sudden drop in yields triggered a flurry of activity as traders scrambled to reassess their positions and strategies. The atmosphere was tense, with many fearing that this could be the beginning of a more significant downturn. The yield on the 10-year Treasury dropped as much as 10 basis points that day. For those unfamiliar with financial jargon, this might not seem like a big deal, but in the world of finance, even small changes can have substantial implications. Now I know what you're thinking. Basis points? What in the world are basis points? It's a term that gets thrown around a lot in financial circles, but it can be confusing for those not in the know. Don't worry, it's not as complicated as it sounds. A basis point is simply a unit of measure used in finance to describe the percentage change in the value or rate of a financial instrument. It's a way to express small changes in interest rates, bond yields, and other financial metrics. A basis point is just a fancy way of saying 1/100th of a percentage point. So, when we say that the yield dropped by 10 basis points, we mean it decreased by 0.10%. It might seem minor, but in the context of large financial markets, these small changes can be quite significant. So, a 10 basis point drop is like finding a dollar bill on the sidewalk. It's a small amount, but it can add up over time, especially when dealing with large sums of money. It's not a life-changing amount, but it's still something. For investors, even these small changes can influence decisions and strategies, highlighting the importance of staying informed and understanding the nuances of financial markets. Section 7. What falling yields mean for investors. A mixed bag. So, what does all this mean for ordinary investors? Well, it's a bit of a mixed bag. On the one hand, falling treasury yields can be good news for borrowers. Imagine you're trying to buy a house. Lower interest rates mean lower mortgage payments, which is always a good thing. On the other hand, falling yields can be bad news for savers. If you're relying on interest income from your savings account, you might be feeling the pinch. Lower yields mean lower interest payments, which can make it harder to make ends meet. Section 8. The broader economic impact, a delicate balancing act. Falling treasury yields can have a ripple effect throughout the economy. For starters, they can influence interest rates on everything from mortgages to car loans. Lower yields usually mean lower interest rates, which can encourage people to borrow and spend money. This increased spending can be good for the economy, but it can also lead to inflation. Remember that vicious cycle we talked about earlier? It's a delicate balancing act. Section 9. Looking ahead, navigating uncertain waters. The recent drop in US Treasury yields is a sign that investors are feeling uncertain about the future. The economy is sending mixed signals, inflation is a concern, and the stock market is looking a little shaky. It's like we're sailing into uncharted waters. We don't know exactly what lies ahead, but we need to be prepared for anything. The best thing investors can do is stay informed, diversify their portfolios, and buckle up for a potentially bumpy ride.